Dear students, in this video, we will be studying about cost of capital, particularly about cost of debenture, right? Cost of debenture is one type of cost of capital. When you issue a debenture to the public, at what cost it is going to have to a company, right? So that is a very important calculation for a company to do it, right? Now, let us see the different types of cost of capital. There are different types of cost of capital. If you see here, the first type, as we are discussing today, is cost of debt, or in the other word, it is called as cost of debenture, right? So the debenture will play a very important role when, suppose, uh, if you are taking a loan from the common people. So how much debentures are going to cost you, that need to be calculated. Cost of preference shares are also very important kind, right? Now preference shares you will be issuing to the public. Now how much that preference shares are going to cost to a company. Similarly, the equity share, you need to calculate the cost of equity shares, cost of retained earnings. And when you combine this all, right, that is combination of cost and weight of each source of capital, that is called as WACC. It is weighted average cost of capital. Okay, so this is the total summary of the cost of capital, right? Cost of debt, cost of preference share, cost of equity, cost of retained earnings, and combination cost, including all the weights. So that is called as weighted average cost of capital. So first of all, we'll see what cost of capital is. A cost of capital is the return expected by the providers of a capital. Shareholders, lenders, and debt holders to the business as a compensation to the contribution to the total capital, where an entity procured finance from either source as listed above, it may pay some additional amount of money beside the principal amount. The additional money paid to these financiers may either one-off payment or regular payment as specified intervals. This additional money paid is said to be the cost of using the capital, and it is called as cost of capital. Okay, see, whenever you are issuing anything, or when you're getting any kind of capital, you need to pay additional kind of things. Additional, apart from the principal payment, when we pay additional to them, that is what going to cost to a company, that capital, it is called as cost of capital. The cost of capital expressed in the rate is used to discount or compound the cash flow or stream of cash flows, right? It is generally used to discount the cash flow, to calculate your discounted cash flow, as well as it is used for the different stream of cash flows. And it is also known as cutoff rate, hurdle rate, minimum rate of return. It is used as a benchmark for. So this is the cutoff rate, means minimum this much at least a company has to get a return on your capital. If you are not getting that much of minimum return, that means you have to pay from the pocket to the outsiders. Okay, so what is the benchmark generally they follow is framing debt policy of a firm, educating capital budgeting decision. When it is done properly, you will have a better this policy. When it is framed, benchmark, if it is framed, then you will have a better cost of capital. Okay, you will have a good cost of capital. So what are the importance, significance of cost of capital? First of all, evaluation of investment options. Now when cost of capital, if you do it properly, if you know how much is the capital costing for a company, then you can analyze your future cash flows, you can analyze your investment opportunities, you can convert the various present value benefits into the various kind of capital. By this you can easily calculate your internal rate of return, you can calculate the projected cash flows. So that means if you calculate, or if you have a better cost of capital calculation in your organization or a company, that will help you to evaluate the different kind of investment options available for a firm. There are various investment options available. Now to analyze those investment option, if anything is more suitable, that is cost of capital. Next is to have a performance appraisal. Now, cost of capital is used to appraise the performance of a particular project or a business, right? Like the performance of a project or a business is compared against the cost of capital, which is known here as a cutoff rate or a hurdle rate. See, your cost of capital is somewhere around 10%. Now, your earning or a performance is 8%. That means you are 2% short, where you can compare that your performance is not better. Okay, suppose your cost of capital is some 8%, while your performance or your profit rate you got is some 13%. Here when we compare, your profit is more than that of your cost of capital. So to measure this kind of performance, right, how much you are performing, whether you are performing well or you are improving or not, to measure this in case of finance, the cost of capital will play a very important role. Designing of optimum credit policy. Now to design an optimum credit policy, like how much credit period should be allowed to the customers, like if you have a very rigid credit policy where you are unable to change it, you will find a lot of difficulty for the purpose of liquidation or for the purpose of liquidity in your business. So if your policy is very much flexible, there also you will have a problem of non-payment, bad debts or doubtful debts. So to design your proper optimum credit policy, the cost of capital is surely going to help you. So that is also very importance of having a cost of capital. Now, what are the determinants of cost of capital? Now, if you see two factors which consider the determination of the cost of capital, first is source of finance, right? Source of finance is the first kind of determinant, and reciprocal payment of using finance. How do we do the payments of the finance? When these two things are properly done, you will find that there will be a proper uh, cost of capital. So these two things are going to determine or define your cost of capital: source of finance and reciprocal payment of using a finance. Like which source you have taken, either you have taken cost of equity, cost of debt, cost of loan, cost of preference share, right? Suppose you have taken cost of you have taken equity, which means you have issued share to the public as the equity shares. Now in that case, KE is applicable, cost of equity is applicable, right? So that is the source of finance. It has made a cost of capital as cost of equity, right? This is the first determinant. Second is, what is the reciprocal payment, on what basis you are paying. Now to the equity share, what you have to pay to equity shareholders, you need to pay the dividend. Now how much dividend you are paying, either you are retaining the profit or you are distributing the dividend to the shareholders, that will again determine the cost of capital. Similarly, suppose you have taken you have issued the debentures and you have got money. In that case, cost of equity will not be applicable, cost of debenture is applicable. Now to the debenture holders, you won't be paying interest, you won't be paying the dividend, you will be paying interest to them. So there again, the different kind of area will be applicable. So the cost of capital has a different kind of sources, which just now we saw, like cost of equity, cost of preference share capital, cost of long term debt, cost of retained earnings. When totally these are added, right, and when you do a sum using the weights, that you will get a WACC, that is weighted average cost of capital. Okay, first is like cost of long term debt. Whenever you take any kind of a long term debt, either by a debentures or any kind of bonds, bank loan from the financial institution, whenever you take any kind of capital from these all things, right, we collected a capital from bank, we collected a capital from debenture holders, we collected a capital from any other sources which are providing you a loan from for a long term purpose. So whatever cost you have to bear, that is called as the cost of long term debt. Okay, now what are the features of the debentures? Debenture are one of the most important prominent long-term debt. So first of all, we need to see the face value, right? Debentures or bonds are denominated with some value. This is denominated value is called as the face value of the debenture, and interest is calculated on the face value. See, whenever a company is issuing any kind of debentures, they will be issuing the debentures whether they are non-convertible debentures or convertible debentures, they will be issuing at some face value. Suppose face value of the one debenture is 100 rupees. Now in that case, they will mention is that as the interest is 9% on the face value. So 100 of that 9% is how much? That is 9 rupees. So 9 rupees will be interest, right? 9 rupees will be interest. It will be calculated on the face value. So this is the first feature of having a debenture. So first of all, there will be face value of debenture, and second is on face value there will be a interest. There will be a interest for debentures. Then next is interest or a coupon rate. Generally, the debentures will be issued at each debenture bears a fixed rate of interest. So whatever interest it is going to be paid to the debenture holders, it will be paid at a coupon rate or at a fixed rate. Coupon rate means at a fixed rate. Like 9% is the debenture, and company is making more profit. Now you cannot claim a more profit to the company. You cannot claim more interest to a company. Or even if a company is making any kind of loss, you cannot tell a company cannot tell you that it is making a loss, so we will not pay you debenture at the same interest rate, because you have been committed, you have given a loan to a company, so you will be liable to get the interest at a fixed or a open rate. Second is maturity period. So debentures, they are for a fixed maturity period for redemption. However, see, the debenture will be for 4 years, 5 years. So maturity period is not defined, and it can be infinite also. Like it can be even any number of years. It can be for 10 years, 20 years. So you'll be getting interest. Now redemption value. So redeemable debentures are both are redeemed on its specified maturity date. Based on the debt convents, the redemption value is determined. So redemption value may vary from the face value of the debenture. So now see, the redemption value is what? Suppose you have taken any kind of debentures. Now, after getting interest for some years, now you want to return that debentures, and you want to get the value of it. You have taken a debenture of 10 lakhs. So if you return that debenture, you may be getting, might be 9 lakh rupees, 9 lakh 50,000 rupees, or even at some point of time, you may be getting even 10 lakh also. So whatever value you are getting, that value is called as redemption value. Okay, redemption value. Then benefit of tax shield. The payment of interest to deduction, the debenture holders are allowed as expenses for the purpose of corporate tax determination. Hence, the interest paid to the debenture holders saves the tax liability of a company. See, for a company, it is very much benefited, because whenever a company is issuing any kind of debentures, so whatever payment they are doing to the debenture holders, that payment of interest to the debenture holders will be included in their tax liability. Okay, so whenever they calculate or determine their tax liability, whatever interest payment they are doing, that will be reduced. Okay, that is going to be reduced, and after the reduction of the tax liability in their total income, they have to pay a less amount of tax to the government. So they will get a benefit of tax shield. Let us see one example. There are two companies naming X Limited and Y Limited. The capital of X Limited is fully financed by the shareholders, whereas Y Limited uses debt fund as well, right? Y Limited is using like debt fund means debentures. X Limited is fully financed by the shareholders, like might be equity or preference shares. The below is the profitability statement of both the companies. So they have given the profitability statement of both the companies. What is the profitability statement? So the X company's profitability statement, let us see. It has earning before interest and taxes, EBIT, what we call, is 100. This is in lakhs. And Y Limited is also 100. Interest paid to debenture holders in X Limited, it is 0, because it is fully issued as per shares, while in Y Limited is 40. Now profit before tax is 100 in X, and Y Limited it is 60. Tax rate is 35. See, because they have not invested more in tax rate, right? Interest is not paid more. That means more amount of tax they have to pay, that is 35. And in Y Limited it is 21. And finally, profit after tax remaining is 35 and 65 and 39. Okay, 65 and 39. Now, if you do the comparison of both the companies, right, when you do comparison of X Limited and Limited, the interest payment of 40 by Y Limited results as tax shield. Whatever 40 they have paid, that 40 payment will be helpful for a company for tax shield, and 40 lakhs paid as an interest at 35%, right? 35% let us take as an interest rate. Therefore, the effective interest rate is 26 lakhs only, right? The effective interest rate is 26 lakhs. Based on the redemption, the payment of maturity debt can be categorized into two forms. So the cost of debenture long-term debt will be categorized in two form again based on their payment. First is cost of irredeemable debt and cost of redeemable debt. So what do you mean by cost of irredeemable debt? Irredeemable debt, a debenture which are not redeemed by the issuer of the debenture, is known as irredeemable debenture, right? These are those debenture which are not redeemed. Once it is reaching the maturity date or maturity year, it cannot be redeemed further by the issuer. So such kind of debentures are known as irredeemable debentures. They cannot be redeemed further. And the cost of debentures not redeemable or not redeemable during the lifetime of the company is calculated as, how do we calculate it? The formula is cost of irredeemable debt or debenture. We call it as KD. KD equal to 1 I divided by NP, right? I is interest divided by NP, while into bracket 1 minus T. I divided by NP into bracket 1 minus T. So this is cost formula for cost of calculation of irredeemable debt, where KD is cost of debt after tax, right? Cost of debt after tax, after payment of tax. What is the cost of debt? That is denoted as KD. While I is annual interest payment, how much annually you are going to pay interest to the debenture holders, that is called as annual interest payment. NP is net proceed of the debentures, or in other words, if net proceed of the debenture is not given, market price of the debenture, that is NP. And T is tax rate, while one will be one is a constant there, so one will be constant and T will be tax rate. Let us see one example here. Suppose a company issues 15% of the face value of rupees 100 each at a discount of 5, and suppose that the underwriting and the cost are rupees 5,000. For the total issue, thus 90,000 is actually realized. How? Let us see. 1,000 they are issuing, 1,000 multiply it by 100. So total value will get is 1 lakh. And in 1 lakh, actually they are paying underwriting cost of 5,000. So if you deduct that 5,000 in 1 lakh, it will be 95,000. But apart from that, they are even doing underwriting, right? And underwriting is also 5,000. So totally the actually realized cost is 90,000. This is because interest in charge of profit, and every year the company shall pay 7,500 as the tax, right? 7,500, because on 7,500, assume the income tax rate, let us take it as 50%. Hence the after tax cost is 90,000, and 7,500, which comes to 8.33%. Okay, let us see a simple example here. 5 years ago, Sona Limited issued 12% irredeemable debentures. The word you have to remember here in the examination, that which kind of debentures are being issued, whether it is irredeemable debentures or whether it is redeemable debentures. Now here, if you see in this problem, the Sona Limited, they are issuing the irredeemable debentures at 12%, right? At 103, at 3% premium to par value of 100. Now see, the debentures, it can be issued on three bases, right? First is on par, on premium, and on discount. Par in the sense, when you issue at the same value, right? The face value is also same, and you are issuing to the debenture holders or shareholders at the same value, right? 100 is the face value, issuing at same value, it is called as par. If it is 100 value, you are issuing for more than the face value. 100 is the face value, issuing at 103 rupees, right? So the extra 3 rupees what you are issuing, right, it is called as premium. And suppose 100 is the face value, if you are issuing at 97 rupees, 95 rupees, less than that of face value, that is called as discount. So any securities, whether they are issuing, whether it is a share, debentures, preference shares, it can be issued on three bases: at par, at premium, at discount. Okay, now in this problem, at 12% irredeemable debt at rupees 103 at a premium to their par value or the value of 100. 100 is the value but issued at 103 rupees. The current market price of this debenture is rupees 94. Okay, the market price is not even 103 nor the par value of 100, but it is 94. If the company pays corporate tax at 35%, what is its current cost of debenture capital? So how do we calculate this current cost of debenture capital? So as I have told you, the formula we have to use, that is KD equal to I divided by NP into bracket 1 minus T, where KD stands for cost of debt, I stands for interest, NP stands for the net proceeds or market value. Okay, NP stands for net proceeds or market value, and 1 into bracket 1 minus T, 1 is the constant and T is the tax rate. Okay, so I is the interest they are paying is how much? It's already given, 12% irredeemable debenture. See, he will not give you directly as interest. He will tell you 12% or whatever value, 13%, 14%. So that is the interest. 12% is the interest divided by the market value is how much? That is 94. 94 will divide it into bracket 1 minus tax rate. So 1 minus tax rate, that is 0.35. So when you divide 12 divided by 94 into 1 minus 35, if you do, you will get 0.0829 in decimal. Now we need to convert that in percentage. Just multiply with the 100, right? 0.08297 multiply with the 100. So we'll get in percentage, that is 8.30 percentage. So this is the current cost of debenture capital, current cost of debenture capital.